Richard Wyckoff logic not working? This may be why. The law of cause and effect not producing quality effects that are profitable. A cause may be an accumulation pattern that has been accumulating for a while, and the breakout, and you have a good run up in effect, and you generate good profits out of that effect. Or unfortunately, you have a cause that you've been wanting to trade, but the effect does not really generates enough profits, and it just slumps and goes nowhere. How can we get good causes that generate effects, no matter whether it's accumulation or distribution? Something to consider. A reminder that big boys enter and exit the markets. They accumulate on falling prices, bad news and new lows. They distribute on rising prices, good news and new highs. And to fully understand which causes are better to trade, is to understand that the big boys run a merchandising operation. You have to understand the merchandising operations of professionals. They accumulate at lower prices, they mark stocks up or prices up, and to distribute at higher prices, pocketing the difference. So if you see a good accumulation, a happy markup or a good markup, and then some distribution, you know that their stock float has been cleared and they're ready to operate again. Just like if you have a good distribution and a markdown, you know that their stock float is cleared and they're ready to accumulate again. The better tradable Wyckoff causes appear after better effects, for the simple reason the merchandising operation of the big boys has been successful. What I'm trying to say here is when you know, or when you see a good markup with a good distribution, you know that the big boys have accumulated, the marks up, they made a profit, then they're ready to mark down. Same on a situation where the price has been marked down successfully. That means you've got a good move down. The boys know that you know that the big boys have distributed their stock float and they're ready to reaccumulate and have another going at markup. Obviously, it depends on the fundamentals at the time and the general market trend, but you have to understand the merchandising operation of the professionals. The more clean and profitable the effect, the more likely the accumulation or distribution pattern will be identified as traditional Wyckoff logic phases that can be easily tradable. Let's have a look at a popular stock, Apple Inc. Here we have a nice little cause. We get an effect. We have a stepping stone causes with an effect. Another stepping stone with more effects. Whoops. A stepping stone. Hang on a sec. Okay, these are the causes here. I'll just draw the causes in. And distribution causes. Not pretty good that one, but we're doing that. What I want to make note here is you can see the sideways patterns. Well, there's one more missing here. We'll just draw this one in here. Bob Evans would say you want to trade stocks that move. What he's basically saying is you want to see stocks that actually have a cause and effect relationship. No point having a chart that's stuck in sideways pattern and only going up a little bit. You want to see stocks that show the professional merchandising operation and effect. You want to be able to see a cause. Here's an accumulation pattern that's appeared after a positive effect. You see the markup, you see another cause, and there's another move. Cause, another move. Cause, not a great move, but another one. Another cause, another move. A cause, a move down. Another cause, another move. The point about it is you can actually say you can see the move. So there's definitely a very powerful merchandising operation going on in the Apple Inc. stock. A cause, a distribution, not such a great one, but another, here's a bit of move down here, so we definitely get some accumulation down here. If you see causes without an effect in your chart, it is not a stock that's been merchandised by the professionals that well. So you want to be able to see the effects on the chart. You want to see the relationship. If you've just got a bunch of causes that are really tight together and the stock really isn't going anywhere, there is no merchandising operation. The professionals are not buying and selling the stock in an active manner. It is not a stock that's ready to move. So in short, to find a better cause that it's going to generate a profit, the actual underlying itself needs to show that the professionals are using it in a manner for a merchandising operation. And the only way you can see that is where they have a period to accumulate, then they mark it up to distribute, and they're banking the profits which are in between. And obviously the better causes appear after longer tradable moves. Hang on a sec. So here's the big moves. As you can see, when you have a big move up, that means this is allowed during the move for the professionals to distribute or accumulate float. So on this move up here, there's a markup process, and as it goes up, the people who have accumulated down here, the very large volumes, have been accumulating and they've been selling into the marketplace. And those that have missed out get a redistribution or a stepping stone cause to continue on. So Wyckoff logic represents the professional merchandising operation. And if a stock is being successfully merchandised, it will show the relationship between cause and effect on falling prices and rising prices, distribution, accumulation. If you cannot see the cause and effect in operation in the chart for the last 3 to 5 years, or 2 to 3 years, whatever, then the stock is not being used as a merchandising operation and doesn't meet your criteria. Also, understand the volume patterns during the course. Here we have an accumulation. We've had a successful effect down. Normally, if it's in a successful effect down on distribution, we have very high volume in this area here. It's because what goes on in this area here, we have people selling, they're capitulating, and we also have short covering, which is buying back the stuff. So here we have people selling and short covering. So there's accumulation going on in there. And we sort of have high volume as it goes into phase B, in this area here, but it's less than the initial volume of the markdown because we have a selling climax. But still high, but what I'm trying to say is the incredibly large buying going on here, lots of volatility, lots of craziness going on in this thing here. And as the volatility and what's been done expires, those people who have accumulated want to know if there's any sellers out there ready to ambush any markup, right? So what they'll do, they'll mark down prices. They're on a low volume, we won't hit them very much, and they want to see if any sellers are topping in here to see if they can push it down or what have you, any shorts to want to create any more profits. And if not, they will mark up. So you have this low dull volume compared to this high volume, and then as the markup process you start to get an increasing volume. It normally starts with a bit of stealth mode, slowly moving up. Then as it breaks support, those people who are short or are in the wrong position will be changing their positions, and those who have been caught by surprise by the markup will be entering the market. So volume starts to increase. So going from the support to going from support to resistance may be just on low volume, and when it gets there, they realise this is on, and then the volume will increase as it gets marked up. Now on the next pattern, on the distribution patterns, it's pretty much the same sort of thing. We have a high, very intense volume here, but high volume continues, but it's normally less. But the differences in here, we may on the swing up, we may get low volume, because there's not really a serious breakout going on. And then the big volume increases on the downside, or I should say increasing volume increases on the downside. So, like I said before, if the market wants to go lower, prices will be raised so they can sell into. It's a lot easier to get prices up and to sell into. Back here, If prices are going to go higher, they will drag prices down to the last instance to buy the last bit and then mark it up. It's a telltale sign. If prices are going to go high, they're going to dip first. If prices are going to go low, they're going to rally first. Because the big boys cannot get good positions if the market has already fallen. They want the market to go higher before it goes lower. In this situation, you want the market to go lower before it goes higher, because the big boys can't get into positions or adjust their portfolios unless the market is falling before it goes up. Obviously, when the market is falling in accumulation, they do not want to see, they want to protect their initial position over here, so they do want to see too much damage here. It may break support, but they do not want to see too much damage. And same on distribution. In the situation here, if they're going to sell it down, they do not want to see too much damage up here, so they can sell it down into. But please be aware, as you can see in the Apple chart, for example, here's a, whoops. Yep. Here the market was shot up, and then they sank it afterwards. So here the market was some distribution, and prices came down. So they always knew at this stage that this is a distribution pattern. Here prices were sunk low, then they shot up because the big boys playing around with the operations of the stock, able to shake out a few stops and enter the market. Same with up here, price just shot up, and they smashed it back down. Same with down here, they smashed it down and took it back up. Same there. Not so much there. But see, like I said before, they just take the market up and then they smash it down. If they want to short it, it will take profits. So if the best thing to see if a stop's going to go up, it's just taken down a little bit below support and taken up. If you know it's going to be distributed, it's taken up to resistance, breaks it, and comes back down again. Remember, the professionals can manipulate price 10-20% as they adjust their positions before or after, during an accumulation process. But the most important factor to wonder whether a Wyckoff logic is working or not is whether the chart shows off successful causes and effects to prove that the stock is undergoing or is suffering from merchandising operations of the professionals. And look for the cause, look the effect, and if it's present in the charts, in your chart, watch the volume between high, low, and dull volume, and the changes to see whether supply has dried up or demand has dried up, to know when the pattern's going to break out. Thanks for watching.